This chart shows the official narrative, a stable private credit default rate holding between 1.5 and 2. This created a paradox. We are in a higher for longer interest rate environment, yet the headline default rates for these non-bank loans remain remarkably low. The Federal Reserve has maintained these elevated rates because inflation has exceeded their 2% target for 5 consecutive years. This discrepancy suggests the 2% headline figure is masking a volume of defaults that traditional metrics are failing to capture. To find the source of that friction, we have to look at 2 specific drivers: the disruption of software revenue by generative AI and the use of payment in kind, or PIK toggles. Identifying these risks requires a granular look at the specific assets these funds have accumulated over the last decade. Failing to account for the difference between reported stability and underlying distress threatens the performance of institutional portfolios in 2026. We'll start by analyzing the portfolio contents of business development companies, or BDCs, which have led the charge in direct lending. For years, software-as-a-service firms were the primary targets for private equity buyouts. The underwriting was simple. These companies have high gross margins and very low capital expenditure requirements. The most critical factor for lenders was the recurring revenue model, where customers pay a predictable fee for every software seat or user. Lenders believed this predictable cash flow could safely support the heavy debt loads required for massive buyouts. This chart shows the result of that focus. BDC portfolios now have an estimated 20% exposure to software companies, 5 times the exposure found in public high-yield markets. This concentration means the stability of the entire private credit ecosystem is now sensitive to the software sector's continued performance. If the per-seat revenue model for SaaS begins to fail, the debt supporting these companies becomes unsustainable. That model is now facing a catalyst for disruption: the enterprise-wide deployment of generative AI. Today, AI agents and automated coding tools are rapidly synthesizing complex tasks that previously used to require dozens of human employees. As companies automate these tasks, they need fewer software seats. This leads to a direct erosion of the recurring revenue lenders relied on. This loss of revenue destroys the pricing power and competitive moats of these heavily indebted software firms. In early 2026, public markets reacted to this shift by pushing software stocks deep into bear market territory. This repricing in the public markets forces private lenders to reassess the value of the software companies they financed. As revenues drop and the value of these businesses contracts, the debt-to-income ratios of these floating-rate borrowers begin to accelerate. The software underwriting thesis of the last decade is essentially broken, leaving many middle-market borrowers unable to service their debt with cash. If software borrowers are struggling to pay their bills, why haven't we seen a corresponding spike in the 2% headline default rate? The reason is a mechanism designed to prevent technical defaults, the payment in kind, or PIK toggle. Let's look at how the math works on this simplified ledger. We start with a corporate borrower holding a $100 million loan. Between the base software rate and the lender spread, the borrower faces an 11% interest obligation. That's $11 million in cash due every year. But the borrower's cash flow has deteriorated and they cannot make the payment. Instead of declaring a default, the fund activates the PIK toggle. The cash payment is crossed out, and that $11 million is added to the loan balance. The borrower now owes $111 million. This prevents the loan from being marked as non-performing, which allows the fund to report a stable net asset value to its investors. While it avoids an immediate crisis, it compounds the borrower's debt burden, effectively delaying the inevitable. The International Monetary Fund has warned about this trend, noting that 40% of private credit borrowers now have negative free cash flow. Public BDC data confirms the shift. 8% of their total investment income is now coming from these PIK accruals rather than actual cash. This chart shows the result of that accounting. The stated default rate stays flat at 2%, but the Fitch comprehensive rate, which includes PIK usage and distressed exchanges, climbs to 5.8%. This creates a systemic disconnect between the book values reported to investors and the actual prices these assets would fetch in a sale. This underlying credit distress is now colliding with a shift in who actually owns these loans. In a push for democratization, private credit has moved from institutional lockups into retail wealth channels like 401ks and family offices. This created a liquidity mismatch. Retail investors expect to be able to withdraw their money quarterly, but the funds are holding bespoke, illiquid loans that can't be sold quickly. In the first quarter of 2026, volatility and AI disruption led retail investors to try and pull $10 billion out of these funds. This table shows the industry's response. To prevent a forced sale of assets, BlackRock, Morgan Stanley, and Apollo all enforced 5% redemption caps, trapping roughly half of the requested capital. When investors realize their capital is effectively trapped, it shatters the liquidity illusion and can lead to even more withdrawal requests in the following months. The combination of failing software debt and unstable retail funding represents the most acute risk to the financial system today. For institutional allocators, navigating this environment requires a new set of strategic directives. Passive allocation into middle-market corporate lending is no longer a viable strategy. The first imperative is a pivot away from corporate cash flow lending and toward asset-based finance, or ABF. ABF loans are secured by hard, tangible assets like equipment or infrastructure. This provides a hedge against the revenue volatility we're seeing in the software sector. It is also critical to use bankruptcy-remote lockbox structures to ensure the collateral is protected if the borrower's operating company fails. The second imperative is to look for opportunities in the credit secondary market. High financing costs are forcing private equity firms to hold their companies longer. This allows specialized funds to buy high-quality loan portfolios at a discount from investors who need immediate liquidity. Navigating a $40 trillion market requires uncompromising credit discipline, a structural awareness of AI disruption, and the analytical rigor to look past accounting flexibility.